Did you know the average American credit score just dropped for the second straight quarter? If you're feeling the pinch, you're not alone. Today, I'm breaking down exactly why this is happening in 2026 and giving you a step-by-step plan to not just protect your score, but actually boost it ahead of the curve. According to fresh data from Money.com, published on April 13th, 2026, the average FICO score in the U.S. fell to 714, down from 718 just 6 months ago. That's a significant drop, and it's being driven by a surge in delinquencies, payments that are 30 days or more late. So what's causing this? Factor 1, rising delinquencies. More people are missing payments on credit cards, auto loans, and personal loans. In fact, credit card delinquencies hit 6.4% in the first quarter of 2026, the highest level in over a decade. This directly tanks your payment history, which makes up 35% of your FICO score. Factor 2, inflation and debt. With prices still elevated, many are relying more on credit to cover everyday expenses. The average credit card balance is now over $6,000, up 15% from last year. Higher balances mean higher credit utilization. That's the amount you owe versus your credit limit, and this accounts for 30% of your score. Factor 3, credit utilization spikes. As people max out cards to cope, their utilization ratios shoot up. Ideally, you want to keep this below 30%, but many are hitting 50% or more. For example, if you have a $10,000 limit and a $5,000 balance, that's 50% utilization, a red flag for lenders. Now here's how to protect your score. First, automate your payments. Set up autopay for at least the minimum due on all accounts to avoid delinquencies. Even one late payment can drop your score by up to 100 points. Second, prioritize paying down high-interest debt. Focus on cards with rates above 20%. To boost your score fast, strategy 1, request a credit limit increase. Call your card issuer and ask. This can lower your utilization ratio instantly without paying down debt. For instance, if your limit goes from $10,000 to $15,000, your 50% utilization drops to 33%. Strategy 2, become an authorized user. If you have a trusted family member with good credit, ask to be added to their old high-limit card. Their positive payment history gets added to your report, potentially boosting your score by 50 points or more in just a few months. Strategy 3, dispute errors on your report. 1 in 4 reports has errors, and fixing one could lift your score by 20 to 40 points. Pull your free reports at annualcreditreport.com and challenge any inaccuracies, like accounts that aren't yours or incorrect late payments. Let's put this into perspective. Meet Sarah. She had a 700 score, missed one payment, and it dropped to 620. By automating payments, paying down $2,000 in debt, and getting a limit increase, she bounced back to 720 in 6 months. You can do this too. Remember, in 2026, economic pressures are real, but you have control. Focus on payment history and credit utilization. They make up 65% of your score. Avoid new hard inquiries unless necessary, and monitor your score monthly with free tools like Credit Karma or your bank's app. So what's your biggest credit challenge right now? Are you dealing with high utilization or worried about a late payment? Drop a comment below. I read everyone and might feature your question in a future video. And if you found this helpful, hit that like button and subscribe for more straight talk credit strategies every week.